All right, so when we are taking the information from the unadjusted trial balance to the adjusted trial balance, we need to take into consideration what accounts would have to be adjusted in order to put that information into the adjusted trial balance. So here are the reasons why we would have to adjust the entries. So one, deferred expenses. So these are expenses paid for in advance and subsequently incurred. Deferred revenue. This is when cash is received in advance of the revenue that was supposed to be earned. So cash was received, but the revenue was not earned yet. Accrued expense. Expenses that are incurred prior to being paid off. Accrued revenues, so revenues earned prior to the receipt of cash. And depreciation, so this is the estimated loss in value that an asset experiences over time. So these are the reasons why we would have to adjust entries. And remember, the adjusting entries is only with the accrual basis of accounting, not the cash basis of accounting. So this is when we're doing the accrual basis of accounting, we would have to adjust the entries and take the information from the unadjusted trial balance, take that information and put it into the adjusting trial balance after the accounts were adjusted. All right, so we're going to go through the accounts that are adjusted and show you how to adjust those accounts. All right, so our first adjusting entry. So Anne holds a 5-day camp for athletes. She charges $250 for the 5 days. All right. Our accounting period ended on March 31st, and her camp starts on the 29th, March 29th. She's not paid until Friday, right? So if our accounting period ends on Wednesday, March 31st, only 3 days of the camp have been earned so far. So if we divide the 250 divided by 5, it ends up that Anne is charging $50 a day for her camp, and 3 days have been earned thus far. So $50 times 3 is $150. So $150 have been earned thus far. All right? So our entry will be accounts receivable because she hasn't been paid for that yet. She's owed that because she earned that revenue, right? So we have service revenue of $150 and our accounts receivable being impacted by $150 because she's owed that money but is not receiving it until Friday. So accounts receivable is our debit, service revenue is our credit, and then our explanation for this adjusting entry is adjusting entry for revenue earned in advance of payment. So that's our first entry. All right, the next entry. Anne pays her employees at Greater Athletic Performance $1,250 for 5 days. So all her employees are paid a total of $1,250 for 5 days. So if we break it down, 1,250 divided by 5 equals $250 a day. So her employees earn $250 a day. And remember, our accounting period ended on a Wednesday, right? So our accounting period ended on a Wednesday. So they have earned a total of $750 because they've worked 3 days and are owed $750 because they don't get paid till Friday. So they're owed for those 3 days $750. So the adjusting entries that have to be made, so we record in our journal wages expense of $750 and wages payable of $750 because we know that we owe that $750 because they earned that money, right? So we owe them $750. So our debit is our wages expense, $750, and our credit is wages payable, which is a liability because we owe it, and that's $750 that we owe. And our explanation for the adjusting entry is adjusting entries for employee wages owed, because they earned that revenue, right? Or they earned that pay, right? So that's that entry. Our next adjusting entry is our supplies expense. So Ann purchased $500 worth of supplies on March 4th. And she found on March 31st, when our accounting period ended, that only $185 worth of supplies remained. So what we have to do is we have to take the original amount that Ann had of $500 and subtract the $185 that remains, and we get $315 total. All right, so we have our supplies expense of $315, which is our credit, and then we actually have to our debit. Our supplies expense is our debit, and we actually have to credit our supplies account because we no longer have those supplies left. All right, so our supplies expense is our debit, and we have to credit our supplies account of $315 because those supplies are no longer there, right? So it's supplies in its negative form, right? So we have to credit it. Then our explanation for this adjusting entry is adjusting entry to record supplies expense. Okay, our next adjusting entry. All right, Ann holds another 5-day camp, but it's an individual lesson, and she starts it on Tuesday, April 27th, and it ends on Saturday, May 1st. On April 22nd, the parent of the child pays Ann $550 in full payment, all right? So they pay in advance, so Ann owes that person her service, right? So she owes the lesson. So we see in this entry, our accounting period ends on April 30th, and the lesson ends on Saturday, May 1st. So Ann gave 4 days of lessons. All right, so if she's paid $550 total for the 5 days, we divide that by 5, and we get $110 per day. So Ann's getting $110 per day for the one-on-one lesson with the athlete. So Ann gave 4 days of lessons, so she earned that revenue. So normally unearned revenue is a liability because you owe the service. So before the 30th, Ann owed those 4 days of service. So on the 30th, she still owes 1 day of service, right? She was paid up front, and she still owes the service that 1 day. All right, so normally unearned revenue is a liability, and it is an owed service because you're paid in advance. But now she gave 4 days of lessons, so that those days are earned revenue, right? So those 4 days are earned. So we have to make the adjusting entry to the unearned revenue account. So our unearned revenue account is actually debited instead of credited because that $440 is no longer owed. So the two accounts being impacted are unearned revenue and service revenue. Our unearned revenue is debited $440 because it's no longer owed, right? And our service revenue is credited because we know that that revenue is earned. So it's $440 credited. So unearned revenue is debited and service revenue is credited. Now normally, like I said, unearned revenue is a liability because you owe the service. You owe those individuals the service. They pay in advance and you owe the service. But since she gave the lessons for 4 days, those 4 days are earned and she still owes that 1 day. So we debit unearned revenue of $440, and then we add our credit to the service revenue of $440. And then our explanation for the adjusting entry is adjusting entry for completion of service. So we know that Anne completed those 4 days of service. All right, so now that we have recorded, we're not going to post this journal entry, but now that we have recorded the adjusting entries, we're going to post them to the ledger, to the T accounts. So I only have a few T accounts listed here, and these are the T accounts that are impacted by the adjusted entry. All right, so accounts receivable is debited $150 here because it's an adjusting entry for revenue earned in advance of payment. So Anne earned that revenue, but she wasn't paid for it yet. So we adjust the entry $150 on the debit side. So our total accounts receivable ends up being $2,350. The other account impacted is service revenue, $150. So we add the $150 to service revenue, and our service revenue account increases to $3,500. All right? Wages expense. All right, so Anne's employees worked 3 days, so they earned that money, but they weren't paid for it yet. So we have wages expense of $750 and wages payable. So our wages expense is debited, and wages payable is a liability because we owe them that money. So that is credited. Wages payable is credited, $750. So we have wages payable, a total of $750 credited, and we have wages expense debited, $750. Supplies expense. So Anne purchased supplies on March 4th, and on March 31st, she did her accounting records, and she found that she only had $185 worth of supplies left. So we subtracted the $185 from the total $500, and we got $315 worth of supplies were used up. So our supplies expense is our debit. So we have a supplies expense T account here, and we're debiting it $315. And our supplies is credited because we no longer have that $315 worth of supplies. So that is credited. So our supplies account is now at $185 total. All right? So those are the adjusting entries in the T accounts. Now we're going to take those adjusting entries and put it to the adjusting trial balance. All right, so once we finish our entries, once we finish recording our journal entries, we post them to the ledger, the adjusting entries, and then we take that information from the adjusted entries in the T accounts and put it to the adjusted trial balance to make sure that our debits equal our credits. All right, so we're going to walk through. Our cash remains the same. It's $12,300, and it's debited. Our accounts receivable changes because Anne's owed $150 for the service that she completed but was not paid for. So we add the $150 to the accounts receivable on the debit side to get $2,350. So our accounts receivable changes to $2,350. Our supplies changes because Anne used $315 worth of the supplies within the month. So only $185 of supplies remains. So our supplies changes to $185. Our furniture remains the same. Now we're going to be getting into further detail of depreciation and things like that. So we'll talk about depreciation a little bit later, but we're not going to do depreciation in these adjusting entries just yet. All right, so our furniture remains the same of $1,000. Our equipment remains the same. Like I said, we're not doing depreciation, so our equipment stays the same at $20,000. Our accounts payable stays the same at 0. But we have this new account, wages payable, because Ann's employees earn $750, but we're not paid for it yet. So we have wages payable of $750. So Ann owes her employees that money. Capital stays the same, $35,000 credited. Our draw is $400. Our revenue changes because we have the $150 that Ann earned for doing the service but was not paid for it yet. So we have our service revenue of $150 because it was earned. So we have total of $3,500 in the revenue account. Then we have our advertising expense, which stayed the same. Our rent expense stayed the same, $1,700, and we added our supplies expense and wages expense, because when you have a debit, you have to have a credit, right? So we have supplies expense added, $315, that's debited, and we have our wages expense, which is a debit here, our wages expense. So wages payable, $750, wages expense, $750, and then we have our supplies that was reduced to $185 and our expense of $315. All right, so we added that to the adjusted trial balance. Now we have to total these out. All right, so when we add all these together, we get a total of $39,250. $39,250. And when we add our credits together, we get the same amount, $39,250. And that's really the purpose of the adjusted trial balance, is to make the adjusting entries and to make sure our debits equal our credits. And we see here that our debits do equal our credits of $39,250. So that's the purpose of the adjusted trial balance. So next we're going to learn about depreciation and how to make the adjusting entries for depreciation. All right, the other reason we would have to adjust entries is for depreciation. Depreciation is the amount that an asset is, the use of the asset, the amount that the asset depreciates per year. So in this class, we're going to use straight line depreciation. The textbook does give you another method. It's called double declining method. But for the purpose of this class, we're only going to use straight line method. So that's what you'll need to know for exams or quizzes. All right, straight line depreciation takes this simple formula. The cost of the asset minus the salvage value of the asset divided by its useful life. Now the cost of the asset is what you purchased for it, so what the organization purchased the asset for. The salvage value is the amount that the company will get when it goes to dispose of the asset, and it's divided by its useful life. How long are you planning on using the asset is the useful life, and that would equal the annual depreciation. So for example, in greater athletic performance, Ann purchased $20,000 worth of equipment, and the salvage value of that equipment is $2,000. So if we take the $20,000 minus the $2,000 divided by the useful life of 5 years, her asset is going to depreciate by $3,600 per year. All right. So $3,600 per year. And a journal entry would look like this. You have depreciation expense. So that's your debit, depreciation expense. Remember, expenses are always a debit. Depreciation expense is $3,600. And our credit is going to be accumulated depreciation. And accumulated depreciation is actually a contra asset. And a contra asset is exactly what the name says. It goes in opposition to the asset, right? So accumulated depreciation is a contra asset, and that's our credit of $3,600. So then we would just put in here a note, adjusting entry for year one depreciation expense. Right? So depreciation expense is our debit, and accumulated depreciation is our credit. And accumulated depreciation is a contra asset. So that is the other reason we would have to adjust the entries for depreciation. And you'll just need to know straight line depreciation for this class.